Welcome back to March to a Million. I'm RJ Malik. Today's episode is different from what we usually do. Greg's been in the financial services for 20 years this year, and he's been thinking lately about what those 20 years actually taught him. Not the highlight reel, the real curriculum. He started in 2006, which means his first year in the business included an 11% market drop. 2 years later, he watched the global financial crisis take 57% off the S&P. He's watched 10 more meaningful drawdowns since, and what he's learned is not what he would have predicted when he started. So today is a reflection episode. 20 years, 10 corrections, 2 systematic crises, and the framework he uses now that he didn't have a decade ago. Greg, welcome, and the floor is yours.
Well, RJ, you wake up one day and you realize that, wow, I've been in this game for a while now, and I've seen a lot. And, when I started in this business, from the straight practice of law, I thought I'd seen a lot at that point in time. I saw the build up to Y2K and, obviously what happened there, but I saw the frenzy of investing going up in there. I remember distinctly one of the lawyers in the firm I was with, and he'd go and get his cup of coffee in the morning, and he'd come in and he'd watch his stocks go up, and it was like gambling, right? It was that type of fever pitch. And so that was kind of my context as I walked into, okay, I'm going to be doing this financial stuff. And, I may have shared with you, that I cut my teeth with a national financial planning and mutual fund firm by the name of Waddell & Reed back in the day. And so here I am. I studied, get my licensing, all that stuff, and I walk right into I'm gonna sell. I'm gonna help people put financial plans together, and we're going to make the world a wonderful place to live in, and walk right into the first experience of losing other people's money. 11% down that first year.
Yeah.
What I found out early on was, the training and the institutional support was all basically thinly veiled efforts to get people into their mutual funds. Call it what it is. That's exactly what I realized early on with that, and so with that, I started moving into because it took me a while to open my eyes on that, but then I started seeing my clients lose value in that instance and others, on top of the cost of the complex that they had. I saw internally, and then I grew to understand that this was not just them. This was the business that, they said that advisors could sell funds that were not their funds, but everything was built in such a fashion to favor their funds, and their fee structures and all those kind of things. And that's when I learned about 12B1 fees and all those kind of things that are trails, that are all this kind of hidden money from the clients, that were there to kind of work against us as the consumer.
You started in 2006. What was the business actually like for you as a brand new advisor when the market dropped 11%? And that was within your first year. So, I mean, your head had to be spinning. So can you describe that?
Yeah, it's, you're out there trying to do right by people. And, at that point in time, so it was 20 years ago, so I was 40. It's not quite, wet behind the ears, but young compared to my retiree clients, because that's who I was normally dealing with, people like that. And for them to take a leap of faith with a guy new in the industry, and then turn around and we lose a substantial part of their money, right away. That kind of shakes the faith, especially when when I was doing this because of my broader mission to, preserve this wealth for families. And so, when all I got in terms of support from my hierarchy there was, stay the course. This will all do well. It will work out, and it does come back, right? It wasn't until kind of the second major crash came to me when my clients were actually starting to use their money. Because up until that point in time, it was just savings. It was just a ledger entry. But when people started using their money, that's when I realized that, hey, this game doesn't work the way that we're told that it works.
Mm-hmm.
So, with that, if you think about it, in my time, there was 2008, we had the global financial crisis. We had 2020, right? 2022, all these major things. And what we realize is, that these major market corrections are not anomalies. As a matter of fact, roughly half the years since 1980 had a 10% drop inside of them. So, I didn't arrive at how I plan today, by accident. It was a long and arduous path that got me to where I am now. And if I think in terms, it was essentially 4 rungs that were all sold to me. And of course, I in turn sold it to the client. The first rungs were, that mutual funds and portfolio construction, and that was supposed to be the end all and be all of it. What I was taught was you have diversification plus professional management, and then you'll get that protection. What I found from my client work was the fees were certain, but the protection was only theoretical. And then, again, in 2008, the protection that I had been told to count on just wasn't there. And that was what drove me to start looking for other solutions.
And what were those solutions?
First solution was that I realized that my time at Waddell, in terms of the institutional management type approach, had to end. Because that was when I started realizing and learned about exchange traded funds. And what exchange traded funds did, at least for my learnings, for at that point in time, was eliminated the cost structure, at least a good portion of it, of the mutual fund complexes. And that was a step in the right direction. When we see the studies about how few money managers beat the indexes, et cetera, et cetera. So that was a good solution from the cost perspective. But again, as that was in place, what I observed through my clients was that didn't solve the problem of the risk. No one's steering that ship. You own the index, and you own its worst days as well. So basically, I traded one problem for another. I got to get lower cost exposure, but when everything was going down together, there was no life raft at that point in time.
Okay, so you're talking about ETFs here. Am I understanding that correctly? I want to make sure I'm on the same page.
Yeah, ETFs, exchange traded funds.
Okay, so they solve the fee problem, but why wasn't that enough?
So when we see in practice, and this one, definitely hit home, is, if you buy an S&P 500 index, when the S&P 500 is going good, you get it. When it goes bad, you get it too. And trying to wrestle with that and believing that, okay, the low-cost exchange traded funds do provide a good alternative, and I use them in my portfolios. But one of the things that was then on the horizon for me is, I had to learn a little bit more about how this stuff worked, how the market works in general. And so I started training on momentum and, how trends and trend analysis and those kind of things, and how that could be used to try to manage a portfolio. It was, rules based, and it was a defensible methodology and repeatable. But as I saw it in my practice, at my level, we're competing against, these companies that, pay gazillions of dollars to trade, 1 millisecond faster than others, right? And fundamentally, there have been changes in the way the market works. And trying to build off of momentum and those type of things, it's tricky. Again, especially when I look at it through the lens of my target client, which is now, using their money, not saving their money. And so, these type of tools work great for people saving, but not for people using. Kind of that tactical investing approach. It manages the dosing, but doesn't change the drug. For somebody in accumulation phase, dose management is often enough. For somebody in retirement, where sequence is the actual enemy, it isn't structurally sufficient to take care of things.
Okay.
So the next thing I had tried to wrestle with is, so having this, tactical type of approach to investing that didn't seem to completely solve the problem. That opened a door to me. Actually, a door was open to me that I didn't think I'd ever go through, when I had a person introduce me to the fixed index annuity. And I, as an attorney that had been brought up in the financial world, I was skeptical of these things. I wasn't quite to the I hate annuities as a dogma, but I wasn't too far away from it. But as I started learning more about this tool, it did change my perspective significantly.
Okay. You're skeptical and now you're changing. What prompted this change from skepticism to now sort of looking at this as a tool that can be used?
It's further greater understanding of what it is and isolating it from the noise, and applying it to, again, my client base. My first exposure to an annuity in anybody's portfolio was when my younger brother was sold one. And I'm like, wait a second, this kid is in his 20s. What the hell is he doing this for? And it was completely inappropriate for him. And the ones that I saw when I was at the mutual fund company, well, they were variable annuities. And they had that cost structure that everybody said makes annuities expensive. So when I looked at what the offerings were within that company, they had the structure of the cost of the annuity itself, the structure of the cost of the mutual fund complex. And so that was my perspective. I'm like, I'm never using these things. But then I got introduced to the new breed, the fixed indexed annuity, which eliminated that layering of cost and allowed greater precision. So I started thinking, okay, that it's not as bad as it was, but this still doesn't make sense to me when I'm trying to accumulate, because that was my mindset, because I was brought up with accumulation. And then as I continued to be educated on this, because I'm a lifelong learner, and I believe if you don't wake up this year saying how stupid I was last year, then you're not learning anything. And what I learned is that it could be a very effective replacement for bonds in a portfolio construct. And that it is really the only tool out there that allows for the income to be guaranteed for life. So when we start looking at it as a tool and realizing that there are no bad tools, there's just bad applications of the tool. My younger brother being sold an FIA, bad application of a tool. A person in their 60s looking to have guaranteed income for their life, good application for the tool. So, here's what it took 10 years to see. The FIA itself wasn't the answer, nor was the mutual funds or the investment, the risk pool. For 10 years, I was trying to solve retirement inside that investment account. And then when I saw the FIA as a solution, now I realize that, okay, this is a question of structure.
Okay.
How does this work? There's no best investment. The right question is, how do we blend all these things together?
So you're telling me that for 10 years you were trying to solve retirement inside the investment account. And this is the moment where you realized you couldn't. And that's when the framework is starting, what you're talking about now?
That's when the eyes started opening up. Yeah. Like I said, I'm a lifelong learner, maybe a slow learner, but I'm a lifelong learner. So when I started seeing that this other tool was out there to be able to put on aside with the FIA and in the investment account, then we're starting to see what makes sense. And like any kid with a new toy, maybe I played with it a little too much early on, and found out some of the quirks on it and some of the problems. I've had disappointing returns on many of these the contracts that were part of my early years because of the timing of when they're issued. It was just a byproduct of the era, and now I've got greater precision on the whole thing. Again, it only took me 20 years to get here, where we have our pilot process that wraps all this in together, and how we end up structuring our solutions to actually meet each of the retirement risks that people have to deal with, and put all the tools in the right alignment.
So you're talking about tools. Is there an example, a real life example that you can state here?
Well, let's walk through kind of a typical solution.
Okay.
Can't use anybody's names or any of that kind of stuff, but
sure.
But here is what we find when we walk through our process. The first step is to understand that there really are 6 fundamental risks that we have to address in a retirement plan. That market risk, income risk, tax risk, inflation risk, liquidity risk, immortality risk. Okay. And once we now realize, okay, these are the 6 risks that all retirees face. How do we allocate for each one of them? And what tools do we use? So we start out, as we do all engagements, with the question, what does it cost to live your life the way you want to live it? Let's figure out what that monthly nut is. And so then with that, we're going to see, okay, what do we have as our income, Social Security, whatever. So what is that remaining amount that needs to be there? How much more money do we need a month? And then we try to solve that for the lowest amount of capital necessary. So let's say this is an example I go through in my live seminars. You got, $750,000. And we start by taking, okay, we have a couple $1,000s a month gap, and it takes us at this point in life with this solution, we have $400,000 that we need to set aside in an FIA to be able to hit that target that we want to hit. So then we have to solve for inflation risk because that number isn't going to be there. Okay. It's going to grow. If you don't count inflation, you end up in a real bad place. So how much marginal assets do we need from that point on to be able to make sure that our portfolio is keeping pace with inflation, that our income is keeping pace with inflation? And when you have that baseline of the guaranteed income, then we can have a little bit of risk on that inflation side. Okay? So we do an analysis that takes another 110,000, whatever, of that bucket to solve for that. And then, okay, now we need to solve for our market risk because we don't want to be pulling out of that bucket at a bad time. Because that's the thing that my first 10 years never really addressed. Where's the money come from if you are in a down market? Okay, so now we solve for that. And then if we have enough room left, then we can now solve for things like the not longevity, or not longevity, because we've got that covered by the income being guaranteed, tax risk. What amount of this bucket can we maybe allocate to Roth conversions or pulling it earlier, things like that have long-term tax implications. Positive. The mortality risk, how do we build that in to make sure, okay, we can set aside this amount of the bucket to maybe buy an insurance policy, replace the lost Social Security, those kind of things. And so the end of all of that is a realization that it's not any of the tools that is in and of itself the key to a successful retirement. It's having a process that addresses those risks and then structures in place to protect against those as much as possible.
It's more like a puzzle than using tools to solve a problem. You're putting pieces together. Am I understanding that correctly?
Yeah, I've grown to call myself more of a strategist than anything else, right? How do we deal with these things? And that's what the 20 years has given me, the context to be able to have these strategies now. And with the whole tie-in to WSN, the attorneys that rely upon me to help them help their clients, these strategies now, all of them have been structured within our large language model our proprietary large language model that we're now able to leverage for our attorney members, that I'm now able to use in my own practice, so that all the mistakes that I've learned of those 20 years, they are all chronicled, and where you're able to assess these things as they come in ways that were never thought of a year ago.
Let's talk to the person who is listening to this for the first time. What's the one thing you want me to do when this episode ends? I'm being the listener. What do you want me to do?
Ask yourself if you have a strategy or a portfolio. They're completely different things. And if you've been enamored by returns and all that stuff, and you've got a bucket of money, but you don't have a strategy, then that bucket will lose value. What magnitude is anybody's guess. With a strategy, you know that you should be able to have the resilience when the market does do what the market does. As we said at the beginning, 48% of the time, 10% loss year over year. When that happens, are you going to be able to withstand that?
Okay, Greg, there's a lot of information here. How can people get in touch with you if they have more questions for you?
The best place to start to get to know Greg and the universe of us is to go to www.gsdupont.com. You can go directly to my law firm or my website for the financial, but the best place to enter into our world is at www.gsdupont.com. I'm on LinkedIn and all the major things out there.
All right, Greg, thank you. I appreciate your time. And if you've not subscribed to the March to a Million podcast, make sure you do that. If you know of an estate planning attorney, financial advisor, or a client who really needs this information, please make sure you share this podcast with them. So for Greg DuPont, I'm RJ Malik, and we'll see you on the other side of the mic very soon.